So how do you? So you obviously, so you basically invested as a passive investor in a current syndication. So how did you do your due diligence on that to make sure they were, had good bona fides and were trustworthy?
Yeah, so 50% of it is the numbers, 50% is the people, is how I do my due diligence. But I'm able to underwrite the deals by looking at the profit and loss statements, the rent rolls, putting it into my model, and kind of seeing, first of all, is this a good deal? This is where I think real estate is very different from any other business or startups. Real estate, if you buy a good enough asset that's already undervalued, if you have a good business plan to raise the rents, the asset kind of runs itself. I mean, at the end of the day, there's a third-party property management that's kind of boots on the ground at the property all times. That's their job. And they're paid like a vendor, a percentage of the income. But like, like whereas a startup, it's very dependent on the offer. I
Absolutely.
do a little bit of, in that vicinity, and people say a lot of it's 99% of it is predicated on the operator. But in terms of real estate, I kind of take a blended approach where I'm going to look at the numbers first, see what numbers and the assumptions that the sponsor is making. And then if they're using a little aggressive underwriting, it's already tipping me off as an investor that maybe I don't even want to initiate a conversation or use my network to start doing
So
further due
what? So what do you mean
diligence.
by aggressive underwriting? You mean that they're doing a lot, big leverage, like a lot of
I mean,
debt?
most deals are going to maximize the amount of leverage. That's
Mm.
why we do this, right? It's a hard asset. We're good using good government loans. But what I mean aggressive underwriting is like assuming for the rents to go up, maybe 3-4% every single year. Now, yes, there may be data to back this up, but personally, when I underwrite deals, I don't want to assume that the rents are going to go up more than 2%, which sort of takes into account just the pace of inflation.
Exactly.
Uh, or, like there's another large one that we'll look at is like the reversion cap rate or the exit cap rate. What are assets trading for in the future? We don't know what they're going to trade for in the future. So we want to use a reversion cap rate that is saying that the market's going to be weaker in the future. If the market is stronger, which it usually typically is, well, awesome, right? We think that even that much more money. But let's go on with the assumptions, thinking that the future is going to suck, and we're to sell into that.